Hello everyone, today we will be presenting about JPMorgan Chase London Well Trading Laws. This is the agenda of our presentation. First, let's take a look at the background of JPMorgan. After the global financial crisis in 2008, JPMorgan had a large amount of excess deposits, which were managed by the CIO to invest and hedge credit risk. These investments are then categorized into the synthetic credit portfolio, which has been increasing since 2007 to 2011. On a deeper level, this SCP consists mainly of credit default swap, which in the form of index series and index treasuries. This is important for its downfall, as in early 2012, to follow the Basel III regulations, JPMorgan started selling off protection instead of unwinding the SCP. As its position grew significantly in the first quarter of 2012, traders began noticing a huge profit opportunity and started buying more of the protection, which caused the spread to grow even higher. In May 2012, JPMorgan has received a loss of $2 billion, and it even reached past $6 billion in June 2012. So what happened?
So risk began when the CIO attempted to reduce the risk-weighted assets of the SCP by adding more position to offset the losses from the existing one, which was misaligned with the instruction of the senior manager. This not only exposed the portfolio to higher basis and structural risk, but also weakened the effectiveness of the hedging strategy at the beginning. And beyond the misguided strategy, risk became more severe due to poor risk management, weak regulatory oversight, and ethical misconducts that lead to cumulative losses of the SCP over time. So how did risk management fail? There are three reasons. First, they repeatedly breached their risk limits, but chose to overlook them, and these limits were not detailed enough to serve as strictly enforced guidelines. Second, although quantitative risk measurements were taken, they suffer from serious technical and operational flaws, especially the value at risk model, underestimating the actual risk by 50%. And finally, moral hazard from trying to conceal the actual losses prevented the regulators from discovering the truth. And this collectively contributed to the huge losses of $6 billion in mid-2012.
So what are the consequences of this event? JPMorgan reported a massive loss of $6.2 billion, which was much worse than the first public estimation of $2 billion. The government stepped in quickly. The bank had to pay over $920 million in fines to the US and UK regulator. If you look at the chart here, you can see that when the news came out in May, the stock price dropped softly in just a single trading session. Furthermore, the bank also became famous as a safe play that managed risk very well, but this event ruined that image. When the bank tried to hide a big loss, people lost trust into the bank, and they trust that at the same time, the top manager didn't pay enough attention to know what was happening. This disaster changed the whole banking industry. It became the main reason why many government regulations like the Volcker rule got much stricter. And people believe that when the bank keeps people everyday money, they should not be allowed to make highly risky bets. So what are the lessons can we learn from this event? First, they were abruptly what had the trader were paid. They were given big, huge bonus for making quick money, but they didn't suffer the consequence when they lost billions. And when people only worry about the money that they make, they not worry about the risk, they're going to ignore the loop, creating the conflict of interest between the trader and the shareholder. Furthermore, we need to know the difference between the hedging and speculation. Hedging is like buying insurance to keep your money safe, while speculation is like making a bet to win more money, and in this case, the trader fall into gambling.
So how do we resolve this issue? Firstly, we would prioritize reducing the RWA by implementing more risk metrics reduction like the CFA or the stress test. Moreover, each new position will require a concentration cap of 15% followed by a net exposure test. Next, we would change the government structure of the JPMorgan. As you can see here, this was the government structure in 2011. And there are three main problems, where the CIO held too much power and was driven by the personal gain, while the risk metrics and risk data were easily manipulated and there were no intimidating oversight from the board of directors. This is why we recommend that the CIO will be restricted in their scope of work, while the board of directors will have more control and oversight on the risk metrics and risk data. And lastly, we will try to reject short-term based volume compensation. And that is the end of our presentation. Thank you for listening.